what really happened with Silicon Valley Bank? Why did it fail? There's a lot of different articles about this. So here's one that we took from Forbes. What to know about Silicon Valley Bank's collapse, the biggest bank failure since 2008. 2008 and 9, there were a lot of bank failures because of risky mortgage-backed securities. So basically, people bought a lot of homes with mortgages that they didn't verify income for. And if you get a mortgage and you actually don't make any money, well, shit, you might not pay that back. And so they took all that and Wall Street sold it to investors. And in 2008 and 9, they figured out, well, damn, all these mortgage-backed securities, these loans that I'm going to get paid a return on, actually I'm not, because so many people defaulted because they didn't actually qualify for them. They didn't have any money. They didn't put any down payments down. So the investors were left holding the bag, and a lot of these banks lent risky money, et cetera, et cetera. And so then they had the Dodd-Frank Act. Oh, we're not going to let this happen again. And so how did this happen again? Well, let's take a look. So Silicon Valley Bank collapsed in spectacular fashion Friday, just days after it announced big losses, creating the biggest bank failure in the United States since the Great Recession and quickly sparking a government plan to protect depositors. So what's interesting about this, a week or two earlier, this bank, Silicon Valley Bank, was getting awards in London. And so the CEO was in London 2 weeks ago. I found out about 9 to 10 months ago, their chief risk officer, when you're a bank, you need somebody looking at your risk and where you're putting your money as a bank. Because basically all these depositors, I open a bank account, you open a bank account, and all that money's there, and the bank doesn't make any money unless they lend it out.
Yep. Or
if they do something with it. So they were lending it out. They were doing mortgages, car loans, mostly for tech owners and tech employees. Because you found out something interesting, right, Ty? What percent of Silicon Valley bank accounts are held by tech companies? Or what percentage of tech companies bank there?
Slightly over 50% of VC-backed tech organizations or tech companies are actually with SVB. They have vast majority of their funds with them, which obviously tech has taken a huge hit, not to mention what percentage of these VC-backed startups actually are even profitable or making any money at this point, which from our experience, a lot of them don't make money for quite some time. So, I mean, it kind of makes perfect sense to me why SVB is failing. But
so it's fascinating, right? In 2020 and 2021, everybody was home, and so a lot of software companies and social media companies and tech-based companies, your Amazons, your Netflix, your Facebook, all these different companies, tech companies, did really well because people were home. They just, hey, I'm going to buy this stuff. I'm going to invest in technology. I'm going to get stuff because I'm just sitting at home. And then 2022, things started to change. And basically what happened is the market's like, well, wait a second. These tech companies are all losing money. And so you saw companies like Netflix, their stock went down 70%. Yeah. Facebook stock went down 40%. Apple stock, even Apple stock was nosediving. It's all these tech companies were doing poor in 2022. And so what that meant is all these VC firms, all these venture capital firms gave these tech companies, these startups money, and they deposited it all in 2020 and 2021. And then they didn't actually make as much profits. And so then they were spending all that money, and all that money was sitting there in Silicon Valley Bank being spent. So the bank account balances went up, and then they started to go down. And so if you're Silicon Valley Bank, you're going to lend the money out, which they did. But then they did some other things with it, which seemed to be safe, but actually ended up not being safe. So here's what it says. It says the closure capped a few tumultuous days for SVB, Silicon Valley Bank. A lender to technology startups, apparently more than half of tech startups that get venture capital money, they all bank at Silicon Valley Bank, right? It's birds of a feather flock together, and Silicon Valley Bank, hey, if you are a tech company and you got venture capital money, come park it here. We got you, and we'll give you special hookups, special loans for mortgages, car loans, and they were even giving loans, high-risk loans to some of these startups that were losing a lot of money. So maybe not such a good idea. I mean, we want these startups to get money and have a chance to succeed, but if they are, if you're using bank deposit money, that's basically what you are. If you're a bank, you have all these bank deposits, you put like $100,000 in the bank, well, I need to lend that out. So I might lend it out in a mortgage, a car loan, but if I lend it out in a high-risk business loan to a company that's losing money, that's a tough one. That one might not be a good idea. So anyway, it said they announced on Wednesday, this is just last week, like this happened so fast, that they had sold $21 billion in securities at a loss. So this is what we were talking about, right? They bought these treasury bonds and mortgage-backed securities that were, and by the way, these are mortgage-backed securities that weren't seeing defaults, like that people were paying their bills. So it wasn't like this really horrible, outlandish decision. But what they did was they locked the money up in 10-year bonds. And if you're a bank and you kind of need to have liquidity, so what happened is all these bank venture capital-backed companies, they're spending all their money. And they were supposed to slow it down. I was watching a podcast. You've probably seen a guy named David Sachs who's been making the rounds on CNBC, Fox News, CNN, all these different places. He owns his own venture capital firm. He's one of the PayPal mafia. He was the COO at PayPal with Elon Musk. Very smart, incredibly successful tech investor, smart guy, very objective. And he was telling all the companies he invested in last year, hey guys, time to slow down the spend, time to be profitable, time to really focus in and make sure we're only investing money that makes us money and makes profits in the business. And a lot of them didn't listen to him. So those bank balances are going down. And then meanwhile, Silicon Valley Bank's like, we've got $100 billion in deposits. We don't have enough mortgages to lend out. So we're going to buy some of these 10-year bonds. And while that seemed to be a good idea, what happened is interest rates went up. And so they were actually upside down in these bonds. Like they were down like significantly, apparently. And so then it said, let's see. So they sold $21 billion in securities at a loss of $1.8 billion. So they had to sell these because they needed for the requirements as a bank, you have to have enough money on hand, right? Yeah. If you don't have enough money on hand, you get shut down. And that's literally updated every single day. Like the government does have good regulation in terms of banks having to prove where they're at on a daily basis. And so their cash levels were coming down because deposits were going down. So they had to sell these securities at a loss to get more cash. And as they did that, now they've got a $1.8 billion loss. And so they're like, we're going to raise $2.35 billion in capital. And so it tried to sell stock, and it came at it from a very arrogant perspective, right? Instead of being honest, like, actually, we're in a shitload of trouble, it was, we're a badass Silicon Valley bank. Everything's fine. Here's some shares, investors. Why don't you buy some shares? And what happened was Moody's, that rates everybody as a company, as a bank, they're like, actually, we're going to downgrade you from an A rating to like a C or a D rating. And they're like, wait, what? And then word got out about that. Investors like, hell no, we're not buying more. By the way, they were trading at $700. They were already down to $300, a week or two ago. And now, of course, it's zero. So in the last year, they had lost more than half of their value because the writing was on the wall. Deposits were going down, and they put all this money in these treasury bonds that were going down. And so now it says shares of parent company SVB Financial were halted Friday morning after falling 64% in one day, following another 60% dive on Thursday amid concerns of the bank's stability. And CEO Greg Becker told the bank's clients to stay calm, but they didn't. They all took their money out, and so it's an old-fashioned bank run. Back in 1929, when there was like a depression, banks were failing and people were literally losing all their money. This was actually before they had like FDIC insurance. I think President FDR, Franklin Delano Roosevelt, came out with FDIC insurance where if a bank fails, you at least have a certain amount of money that are backed up. So in this case, there was $250,000 in FDIC insurance per bank account, but like a massive amount of the money there was actually not insured. It was way beyond $250,000. If you're a big company with 100 employees, 50 employees, like that's nothing. That's one payroll, and all of a sudden that money's gone. So, wow. So that's a lot of shit that just went down. Let's kind of take our breath here and break this down. So what are your thoughts in hearing about how Silicon Valley Bank failed and why it failed?
I mean, I think it comes down to they weren't diversified, right? You look at it like this, things are going really well. You're getting constant deposits. Cash flow's great. Let's buy these bonds. And then all of a sudden, big tech gets absolutely obliterated. Everybody that's been making all this money, all these businesses, all these individuals that you're banking on depositing are now losing jobs, losing money. They don't have the cash to bring in to infuse your bank. I think that's exactly what happened. And what's crazy too is not just did they like I think it was the CEO that sold off a bunch of his
He
shares.
sure did.
That Friday.
You're damn
Not
right he
only
did.
that, but they also gave all managers like a massive bonus that morning
Friday.
as well. I'm kind of thinking that we're about to see a lot of fraud that's going to be unveiled. I don't know. That's just my take. I'm smelling something a little fishy here, but
I think you're right. And one of our mentors, PBD, has said that 2023 is going to be the year of the investigation, right? You know, what kind of work was our government doing? What did Fauci say? Was it right, wrong? What about all these, companies that took money? There was PPP loan fraud. You've got other frauds with all these government programs, and it's into the billions and billions of dollars. You've got charities that were supposed to be taking charities to help people or to help like different causes, like, I won't mention them, but they were buying houses with the money, right? They were doing crazy stuff. So you've got all these different people that took advantage of the last 3 years of the easy money, and now it's going to come to roost. I think it's a great point you bring up. Silicon Valley Bank failed because they, in business, we always say start out with a niche. So their niche was, hey, we are tech companies. We are the banker for tech companies. And they went all in with that. And then at some point you need to go into different verticals when you get big, but they never did, right? They never went into the vertical of, hey, we're going to deal with, plumbers and retail stores and regular business owners that are a little bit less risky than a tech startup. And we love tech startups. I mean, we're in some ways a fintech startup ourselves, but we are a profitable business and have worked hard to get to that position. But a lot of tech companies are not. So you've got high risk there where they might have $1 million in that bank account. And by the end of the year, if they run out of money, they're gone, and they're gone as a client. And then if you gave them loans, well, are they going to pay them back? They're going to struggle to pay them back, right? And so if you don't go after a more conservative base of business owner of clients, then you're right, you're not diversified. And then if the majority of your capital goes into long-term treasury bonds, and if you need money, like I don't understand how that could make sense. So here's what I didn't understand, and maybe you would hope they understand this, but if you're a bank and you lock up your money in a treasury bond, but the value goes down in between and you have to sell it, then you're going to lose money. And I think that's where a lot of people didn't know that, but they should have known that.
Yeah.
So that kind of leads us into our next article here. So how do you lose money specifically with treasury bonds and WT, HRF, whatever you want to say? What is mark to market and how does this work? That is a great question. So here we go. So this is an article from Bloomberg. Jillian, if you want to share this one with the audience. So this is SVB's 44-hour collapse was rooted in treasury bets during pandemic. So let's unpack this. So Greg Becker, the CEO, sat in a red armchair at an invite-only conference in Los Angeles last week. And he said, we pride ourselves on being the best financial partner in the most challenging times. And that's what he was telling. And then he was at the Bank of the Year honors at a London gala. Oops, I guess that wasn't a good award to be given them. A week later, it all fell apart. SVB's collapse into Federal Deposit Insurance receivership came suddenly. Let's see if we can get... All right, U.S. venture capital-backed companies raised $330 billion in 2021. A lot of them put that money in, and then, of course, they've spent that money over the last year. SVB took in tens of billions of dollars from its venture capital clients, and then, confident that rates would stay steady, plowed that cash into longer-term bonds. In doing so, it created and walked straight into a trap. Becker and other leaders of the Santa Clara-based institution... Let's see, it's the biggest bank failure since Washington Mutual back in 2008. And everybody was back there doing mortgages like I was with WAMU. WAMU was a big mortgage-backed company, and they did give out some high-risk loans, and they sadly were the biggest bank failure. They went from like $300 billion to like $2 billion. And so this one is just a little bit smaller than that. And they were trying to lock up $2 billion in capital. They couldn't do it. And then investors and depositors tried to pull $42 billion on Thursday. And so they had violated the cash requirements to have money out, and basically that's when the government stepped in. So here's what's interesting. So it says the bank's total deposits exploded high over the prior 12 months to about 124 billion from 62 billion. And so that was a big increase. But then basically they took that money. So let's break this down. So they had all this money. They lent out some of it to tech founders so they could buy houses. Probably okay. They're making good money a lot. Hopefully they made good decisions on that. But they've got collateral, right? It's lower risk. They've got the properties collateral. They gave them car loans. They got collateral. And then they gave out some business loans. Hopefully they made good decisions there. I don't think anybody knows. I'm guessing that there's been some defaults there. There's a lot of tech companies that struggled the last 18 months. So I'm guessing they had defaults there. So they had some pressure, but the majority thing that took them down, if what we're hearing is accurate, is they had all this money and they didn't have anywhere to put it. So they're like, we'll put it in treasury bonds. But instead of doing maybe shorter term bonds, they did a 10-year bond. So if they put $100 million in it, I think it's maybe $80 billion that they put into it, $85 billion, something like that. If you put it into a 10-year, you make 2% a year, let's call it, and at the end of 10 years, $100 billion becomes 120. But if you have to sell it in 1 to 2 years, which is what they ended up having to do because all these tech companies were draining their bank accounts because they weren't making money, they were just spending it. Well, if that happens, then they have to sell those bonds. And now, because rates have gone from, 1 or 2% up to almost 4.75% with the Fed rate, there's a big gap there. And so now nobody wants to buy your 10-year bond that you bought at 2%. They're buying the 10-year bond at 5%, right? And so that's what's happened. And so now that 10-year bond is actually not worth $100 billion. It's worth $85 billion. And so they have a $15 billion loss there. But the government regulators actually didn't make them count it because they hadn't sold it, right? The old idea where, hey, if I don't sell the stock, I haven't lost it yet. And if you're patient, time will generally help you win as long as you made a good decision. But if you can't be patient here and you have to sell it early, then you take this massive loss. And so that's how you can lose money with treasury bonds. Who would have thought?
Yeah, it's really interesting. And as you're talking more and more about this, it's starting to make more and more sense to me, Leo. It almost feels so simple. Like when you look at these VC-backed companies, like we've talked to some of them recently. VCs tell you have to spend that money. If we're going to give you that money, it's got to be spent, right? And that's where you see, like, even right in our backyard, some of these big VC-backed groups, like Christmas time hits and it's like, well, shit, we have all this money. You get a Peloton, you get a Peloton, you get a smoker. Let's spend the money, get it out of here.
It's like Oprah, everybody gets it.
And it's like, no shit. All these companies, big tech is booming. They're getting all these funds from VCs. They deposit those funds. They're required to spend all this money. The business isn't doing well, so the money's not being replenished. It seems so simple.